Okay, I want to welcome everyone to our webinar today on navigating the changes to Section 174 of the Internal Revenue Code. My name is Greg Carlson. I'm one of the tax partners here at Boehm Berenshire. I did want to point out a few items as you're watching the webinar. There is a chat feature at the bottom, as well as a spot where you can ask questions. Feel free during the program to let us know if you've got any questions, and we'll try to get those answered. We are recording today's webinar, and it will be available on our website, www.myboehm.com, under our blog page. Without any further ado, it's my pleasure to introduce Dave Hansen, who is the Director of R&D Tax Credit Services with Aprio, which is a CPA and business advisory firm that is headquartered in Atlanta, Georgia, who's very familiar with today's topic. So with that, I will turn it over to Dave.
Great, thank you, Greg. And thank you to everybody tuning in today and for spending the next hour or so with us on your lunch break. As Greg mentioned, my name is Dave Hansen, and I'm Executive Director of R&D Tax Credit Services at Aprio, and has spent the last 14 years specializing in tax implications of R&D costs. So happy to be here today. Thank you to Boehm Berenshire for hosting me. All right. So a little bit about Aprio before we get started today, just to add on to what Greg mentioned. So we're a global CPA firm with a world-class R&D tax credit team, and we work with a wide range of clients from startup companies to Fortune 100 across varying industries. And we have more than 35 fully dedicated R&D specialists comprised of CPAs, lawyers, engineers, and technical writers. And if you have opportunities to claim a research credit, we'd be honored to be an extension of your team at Boehm Berenshire. So the next slide that we'll go through just kind of lays out some common indicators for R&D credit opportunities. I know many of you on the line today are likely claiming a credit, but if you're not, we wanted to hit on these items because there may be an opportunity for you to claim a credit, especially in context of what we'll be discussing next. An R&D credit can help offset some of the additional tax burden that you might be facing as a result of some of these new Section 174 changes. So ultimately, since the R&D credit was originally enacted by Congress to be a jobs incentive, to the extent you have engineering, manufacturing, or software development types of jobs here in the US, there's a high likelihood that you'll qualify for a research credit. There's also a good federal opportunity for startup companies. And in Minnesota, certain contributions to certain types of qualified nonprofit companies that are predominantly charged with writing grants for small, innovative, technology-driven companies. Those types of expenses can qualify for the Minnesota credit. All right, so what you see on the screen here is what we'll be covering today. We'll discuss the tax definition of R&D costs. We'll talk through recent changes to the tax treatment and what that impact can mean to your cash flow. We'll talk through action items that you should be considering now to incorporate these changes, as well as the ripple effects into other tax issues. But the general theme of what we'll be covering today is, the tax world kind of got upside down, to the extent that these changes will maintain in place for next year. For companies that have been in growth mode, so maybe tech companies or startups that have been investing in technology, all else equal, will be paying more in taxes for 2022 under the current law than they have traditionally been paying. It could even potentially flip a taxpayer who had been previously in NOLs into a taxable income position. So important things to cover, but we'll also, in addition to talking about the what the law is, where it came from, and how we should be accounting for it. We'll also talk about ways that you can consider minimizing the overall impact to your bottom line. So, Greg, anything else that you'd like to add before we dive into the agenda?
No, I think we're all set.
All right. So up first is a little bit of a kind of background. So you might be asking yourself, what is Section 174 of the tax code? And you'll hear tax practitioners use a few different terms interchangeably. You'll hear us say R&D costs for research and development. You'll hear us say R&E, that's research and experimentation costs. Or you'll hear us say Section 174 costs. And we use all of those terms interchangeably. They all mean the same thing. And you might ask, well, why 174? What is that number affiliated with the R&D costs? And that's just the section of tax law that was written by Treasury and enforced by the IRS that governs the tax treatment of R&D costs. Section 174 is the reason why prior to 2022, you've been able to write off your R&D costs in the year that you incur them. But unfortunately, that's what's changed for tax years beginning on or after January 1st, 2022. And we'll get into what changed here in a moment. But before we do that, I think it might be helpful to clarify the difference between an R&D deduction and the R&D credit, because they are two different things, and they oftentimes will get confused with one another. So we'll go to the next slide here. And I love pictures, especially when we're talking about complicated aspects of tax law. But before we tee up exactly what this Venn diagram is illustrating, let's quickly revisit the difference between just a standard tax deduction and a standard tax credit. So you'll probably recall that a deduction is the portion of cost that you would net against your taxable gross receipts to arrive at your taxable income. And then from there, you multiply your taxable income by your tax rate to arrive at your tax liability, what you would actually owe in your income taxes. So a credit, on the other hand, is generally a dollar for dollar reduction of that tax liability, and it's typically more valuable than a tax deduction because you have to tax affect that deduction to make it apples to apples equivalent with what a tax credit would be. So now if we look at this Venn diagram, you'll see that Section 41 is that yellow circle, and that's the tax code section that governs the R&D credit. And you'll see that it's a refined version or a subset of 174 R&D costs in totality. So not all 174 costs are 41 costs, but all 41 costs, meaning all R&D credit eligible costs, are 174. So that's how that works. So R&D credit eligible costs, if you look in that yellow circle, would be things like the taxable wages, direct materials or supplies, and 65% of contract research that you would incur for activities in the US. And those are what's eligible for the R&D credit. And other R&D costs not eligible for the research credit is what you see in the bigger circle, which would be things like foreign research, 35% of contract research costs that's excluded from the credit, certain types of overhead, and other applicable costs related to research and development. Greg, any input on that one before we jump to the next one?
At some point, did you want to discuss kind of how we got here, where this legislation originated?
Yeah, let's jump into that. So, prior to this law change, there was both sides of the aisle, both the Republicans and the Democrats. Neither side actually ever wanted to disincentivize companies from investing in R&D types of activities. So we'll go through kind of the old state of the law here next. But at the end of the day, the reason why this law is changing is because when the 2017 Tax Cuts and Jobs Act was enacted, in order to figure out how to pay for that corporate tax rate going from 35% down to 21%, they had to figure out how to get the congressional budget balanced in a 10-year scoring window. That was how they were able to pass the tax change through needing only 51 votes instead of 60 votes, as if the budget balanced. And so as a shortcut to achieve that balanced budget, what the legislators did was they said, all right, in 5 years from now, in 2022, we're going to say that these previously deductible R&D costs are no longer deductible in the year incurred, but instead you have to spread out that deduction over 5 or 15 years, depending on if it's foreign versus domestic, instead of being able to recognize that deduction all in the first year. And as I mentioned before, both sides of the aisle, neither of them actually wanted to disincentivize companies from investing in R&D, but this was just kind of the shortcut they took to be able to get that budget balanced. And I think both sides of the aisle anticipated that they would be able to correct this law change before 2022 came about, before it even became an issue. But it's tough to legislate right now. It has been for the past several years. So here we are having to deal with it. But that's kind of how we got here. And I think this is probably a good segue into this slide. So this kind of outlines what's changing about 174. So before 2022, 174 was a super flexible tax provision that allowed for many different permissible methods of treating your R&D costs. You could fully write them off in the year that you incurred them. That's the most common methodology that companies used. You could also capitalize them over a period of 5 or more years. You could amortize them as a capital expenditure over the useful life of that asset that's being developed, or recover them over 10 years under a different but similar tax code section. And then prior to this law change, there was also guidance that separately addressed permissible methods of treating software development costs. And similar to 174 costs, software development costs could be fully deducted in the year that you incurred them, or capitalized and amortized. So lots of different ways to treat these types of costs and activities. And so before 2022, because there was so much flexibility in how to properly treat these costs, there wasn't really any scrutiny on what should actually be considered a 174 cost. That the IRS just really didn't care because there were so many different ways to treat them. So this brings us to what has actually changed for tax years beginning on or after 2022. And I kind of think this is probably one of the saddest slides in the deck. So each of these boxes here you can see is what was changed. So the ability to immediately deduct R&D costs in the year that you incurred them is eliminated. The definition of 174 costs or R&D costs now specifically includes, and I'm going to use air quotes here, any software development. So now any software development is considered an R&D cost. And now the costs have to be capitalized over 5 years if they incurred, if the activities related to that cost occurred in the US, and then over 15 years if the activities related to that cost were occurring outside the US. And then, as if it couldn't get any worse, the statute actually requires that taxpayers use the mid-year convention, which essentially only allows half year of amortization in the first and final years. So in reality, instead of 5 and 15 years, you're recognizing these expenses over 6 and 16 years based on the location of the activity. So as you can see, the new 174 rules are much more rigid and requires companies to clearly identify R&D costs, even if similar costs were previously eligible for multiple tax treatments prior to this. So is there hope for a repeal or a delay? I think the short answer is yes. There is hope. I'm encouraging my clients to hope for the best, but prepare for the worst. Because for the past 5 years, most tax practitioners have been saying, yeah, this is probably going to get deferred or repealed. Just let's wait this out a little bit. But as time has gone by, and with other legislative priorities that have been added to the agenda, with what's going on in Ukraine, and other things, it's being pushed aside. There was some hope for repeal or delay in the Build Back Better plan that ultimately didn't make its way through legislation last year. But we're hoping that now that the midterm elections are behind us, for the most part, we're hoping that now in this lame duck session, it'll allow our lawmakers to focus on not only this tax extender and this law change, but some others as well. So been hearing a lot of noise on both sides of the aisle that there is support for this. There's been tons of lobbying and tons of business organizations and trade organizations that have been sending in letters trying to get this thing situated and kind of turned back over to the old regime with respect to how these are treated. But it's not too late for you to give your lawmakers a call and let them know just how big of an impact this could have to Minnesota companies. All right, we'll pause there. Any questions coming through in the Q&A, Greg?
Not as yet. And I know that you're going to be discussing some of the state and local impact, but that's also going to be something to watch out for, because as is often the case, there is not always a perfect matching of federal and state law, and whether the individual states have adopted this provision. It's kind of a patchwork at the moment.
That's right. Yeah, it's another monkey wrench to throw into this, and we will have a slide that addresses the state impact to a certain extent later on, but we'll definitely go through that. But if anybody has questions, drop them in the Q&A, and we'll try to address them as we go. So now we're going to jump into the impact on your tax liability and cash flow. And so to do this, we created a few examples to try to walk through how this would work. So in this first example, we have 3 companies who each incur $20 million of R&D costs in 2022. Company A's costs are 100% related to domestic activities in the US. So no activities outside the US. Company B, their costs are 100% related to foreign activities. So none of their R&D is in the US. And then Company C's R&D activities are 50-50, half in the US, half not in the US. And so before the Tax Cuts and Jobs Act, all 3 of these companies would have been able to fully deduct that $20 million of costs in the year that they incurred them. But now that after Tax Cuts and Jobs Act, these costs have to be spread out over 6 or 16 years, depending on the location. So the table on this slide shows the deductible portion of the $20 million spend for each company. So Company A there, since 100% is US related activities, you would essentially take that 20 million and divide by 5 years, because that's the life over which you have to amortize these. But you'll see there that, if you divide 20 by 5, that would be 4 million per year. But in year 1 and year 6, it's actually only 2 million because of that mid-year convention. Company B, since 100% is related to foreign activities, you would divide that 20 million cost by 15 years, which gives you about 1.3 million per year. But since you only get half in years 1 and 16, the first and final year, it ends up being 667,000 of a deduction for year 1. And then for Company C, 50-50 US and foreign, it's the hybrid of A and B. So you can kind of see that's the deduction that they get. It's kind of the middle of those two. So the next slide will kind of extend this example a little bit further to show how it could impact taxable income. So in this example, we'll take the same fact pattern for each of the 3 companies, and we'll assume that each company has 10 million of taxable income before they consider their R&D costs. And we'll assume that they had the same income and the same R&D costs in both 2021 and 2022. So you can see the impact of the law change between the 2 years and see that year-to-year comparison. So that first column there for 2021, all companies could treat these R&D costs the same. So they had 10 million of taxable income before, then they took the 174 deduction of 20 million and ended up in a taxable loss position of negative 10 million. Multiply that by the tax rate of 21%, you get 0 of a tax liability. Now in 2022, you take those deductions for year 1 that we just walked through on the previous slide, and you can see that Company A now has taxable income of 8 million when they previously had losses. Multiply that by 21% tax rate, and they've got a 1.6 million tax liability. But the good news is, since Company A, 100% of their R&D costs were in the US, so a portion of that tax liability can be offset with a research credit to the extent that they have some 41 costs as part of their overall 174 pool of costs. And it might be good just to kind of level set a little bit. I'm going to go back a couple of slides to point one thing out. So you see the credit eligible costs here in the yellow circle. What we typically see, and it depends on a company's facts and circumstances and overall global footprint, but what we usually see that if we're comparing proportionally R&D credit eligible costs to the overall 174 cost, we're looking at maybe the size of a tennis ball or baseball to the size of a basketball. So we're seeing that 174 costs are probably anywhere from 1.5 times to 5 times the size of your credit eligible costs. So if we jump back to this example here, a portion of that 20 million could be credit eligible. And so if we take that same proportion, if we say a quarter of that $20 million of costs, that'd be, I'm going to do some mental math here that's dangerous, but about 5 million of credit eligible costs. Company B, similar fact pattern, but company B, 100% of their activities were outside the US as far as the development goes. And so you can see there that now they have a $1.9 million tax liability in 2022, and they don't have that opportunity to offset any of it with their R&D credit since it wasn't US based. And then company C, you can see they have a $1.8 million tax liability in 2022, and a portion can be used to offset that liability with R&D credit, but only to the extent that it qualifies for R&D credit and it was performed in the US. All right, so, as discussed before this law change, Section 174, super flexible. And because of this, there really wasn't much scrutiny or emphasis placed on where these costs showed up on your tax return. They could show up in your wages, they could show up in your cost to get sold, other deductions, etc. But now that taxpayers are required to identify them and know where they are taking place, you're probably wondering, well, how the heck do we do that? How exactly do we ring fence these 174 costs to know just what we have to capitalize and amortize? So first, you have to consider all the activities that could potentially be considered R&D. And as we mentioned before in the beginning of the presentation, the tax definition of R&D is much broader than what most people think of when they hear that term. They think of white lab coats and test beakers. But because Section 174 and Section 41 of the tax code was originally intended to be an incentive to encourage companies to have these types of jobs in the US and to perform these types of experimental and knowledge-seeking activities, the definition of R&D is a lot broader than most people think of. And so if you do have, the traditional R&D, what you would typically consider as, book R&D or financial accounting R&D, all of those costs are kind of the bare minimum of what you would have to consider to be 174. So if you classify them for any other purpose besides tax, there's really no question that they would be 174 based on the standards between financial accounting and tax. And then to the extent that you're claiming any of these costs in your research credit, by nature of the definition of a research credit eligible costs, it's a 174 cost. So that would be in addition to things that would be considered core R&D or core development groups, any other cost centers where your company has employees with a technical or scientific background like engineering, software development, software architecture, things like that. To the extent that you have employees that support, interact with, or otherwise supervise these R&D cost centers or departments, they would need to be considered as well. So common cost centers that come to mind would be maybe a portion of your IT group, quality, operations, etc. So one of the questions we get is, well, I just provide engineering services to my customers. So I'm not really eligible for this, or wouldn't have to treat our costs for 174, would I? And the answer to that is, well, it's still something that you need to consider because there's a lot of unsettled tax law and ambiguity right now with what's considered to be 174. So to the extent that you do have any product development, software development, engineering, or other kind of scientific research happening at your company, it's something that you're likely going to have to take into consideration for this next year as you plan on your 2022 compliance. Excuse me. So once you've identified, the cost centers where these scientific types of experimentation activities are occurring, then you look at the direct cost and indirect costs of those activities. So direct costs, would be certain types of R&D costs that might be captured in your project accounting reports, wages, direct materials, overhead associated with that project accounting record. And then as far as other direct costs that aren't credit eligible that would need to be thrown in there would be non-taxable fringe benefits that aren't part of an individual person's W-2, patent filing fees, foreign R&D costs, things of that nature. And then once you've identified all of the direct engineering costs or R&D costs, at that point, then you look for the indirect costs. And this is, as I mentioned before, there's even more ambiguity because the tax definition of R&D right now includes the term all costs incident to research and experimentation activities. And I'm using air quotes when I say incident because that term is not clearly defined in tax law and leaves room for a lot of interpretation. Does incident to all R&D costs, does that include overhead costs for all departments, even like a finance group or an HR group that technically does provide some level of support for the engineering teams? Or are we able to exclude it because it's far enough removed and wouldn't fall under the category of incident to R&D? That's something that companies are having to consider right now as they're coming up and with the different modeling scenarios of their R&D costs as to whether or not, if the IRS includes things like that, those allocations in the overall pool, what impact would that have to your taxable income? But we are awaiting further guidance from the IRS. They've been, for the past year and a half, they've said that it's high on their priority list to issue 174 regulations, some new ones, because there haven't been any regulations or rev rulings or even procedural guidance that's been released since the Tax Cuts and Jobs Act changed this definition. And so I'm wondering, and this is Dave wondering, if that's indicative of the fact that maybe they think this could be repealed. Don't know, but I'm hoping that's the case. The AIC, yeah,
Dave, in this process of identifying costs, are you seeing businesses actually trying to identify these the 174 costs on their in their accounting systems, or are you expecting that most businesses are going to be just trying to do some kind of a calculation at the end of the year based on their existing accounting systems?
Yeah, that's a good question, Greg. It's a mix of both. Some companies are saying, how can you help us implement something into our system that can help track these things and identify them going forward? I would say that the majority of our clients are just kind of using what they do have and trying to cobble up something, at least for modeling purposes. Once we get into the actual tax filing position and what the actual numbers should be, then they'll probably sharpen their pencils and try to get a little bit more refined in their approach. But if I think how we would do a Section 174 study before the tax law changed, it would be using any of the records and systems that they currently have and piecing different things together in a way that's reasonable, that gets the taxpayer to the closest and best or most optimal answer for them. So it is a mix of both, but I would say that the majority of our clients don't have systems in place that track these things. And so it's a matter of looking at if they have a trial balance by department, that's a huge step forward because they can see, all right, what costs that they're currently capturing or allocating for their engineering group or their IT group. And if you have costs related to sales and you're not including any of those sales folks in your development process, if it's traditional routine sales activities, then you could probably feel comfortable saying any cost that we have captured in that cost center or that department, we can right off the bat exclude from 174 treatment because there wouldn't be any traditional sales routine happening, after, while there's still uncertainty with the product that's being developed. So it's different for each taxpayer, but to answer your question, it's kind of a mix of both. Same as how we would do an R&D tax credit study. There's no requirement in the tax law that says you have to have specific timekeeping records or hours tracked to a certain project it's nice when companies do, but companies that don't would still be entitled to the research credit by using, a survey-based approach or some other reasonable method to track and identify what would be considered an R&D activity and cost.
And David, it seems like it's also possible that some businesses don't qualify for the R&D credit, and yet they're still going to get pulled into this 174 capitalization unless the rules change.
That's exactly right, Greg, because it's mandatory. A lot of companies are saying, oh, well, if I don't claim a credit, this doesn't apply to me, right? And unfortunately, that's not the answer. To the extent that you haven't been claiming a credit, I think it's a good time to reevaluate if maybe you could claim a credit, since you'll be having to look at these costs anyway. And a lot of companies who also have not really been interested in an R&D credit because they've been in NOL positions. Now, since A, they're looking at these costs anyway, and B, the lack of being able to deduct these costs as incurred might actually pull people out of those NOLs, in which case, it'd be a good time to reevaluate if they can offset that tax liability with the credit. They should. But yeah, to answer your question, whether or not you claim a credit or are even eligible for credit does not have an impact on whether or not you have to evaluate these new rules. They can still apply to you. And then I guess the last thing to hit on this slide. So if you look at that last bullet where it says where to look, I think this also kind of gets to Greg's point where, if you don't have project accounting, cost center accounting would be great, but in absent of that, GL accounts where you're tracking the cost for your general ledger and other reports would be a good starting place to peel back the different layers of the onion. Okay, so we talked about kind of what is 174. We talked about the cash flow impact. Now we're going to talk about some ripple effects. And so, there's several different bullets here of things to consider, whether it's your estimated tax payments or financial reporting or provision estimates. These new rules do have an impact on that area, especially for taxpayers who have to account for the deferred impacts that this would have on their international items, for example, which we'll discuss in a moment. Form 3115, that's a tax form that would be included in your tax return anytime that you have a change in accounting method. It's your way of letting the IRS know that you used to account for certain costs on one permissible or impermissible way if you identify that you've been accounting for something incorrectly. It's notifying them that you're moving to a permissible method, and 174 is an accounting method change. Right now, it's actually a non-automatic accounting method change, but what we've heard from multiple sources on Capitol Hill is that the IRS is likely to be issuing a new revenue procedure in the next few weeks that will convert it from a non-automatic method change to an automatic method change. And what that means is, for a non-automatic method change, that requires IRS consent in order to change your method. So I'd have to assume that the IRS, they wouldn't want a million taxpayers filing these things to ask for permission to change their accounting to something that's now actually mandatory. But the other thing is, if that RevProc does not come out by the time this year is over, for any calendar tax year taxpayers, technically a non-automatic method change, this Form 3115 would have to be filed during that tax year that you're seeking to change that method. So it would be very, very silly if this doesn't get converted to an automatic method change before the year end. So we'll be sure to keep you posted on that, but just one thing to keep on the radar. And then from a documentation or due diligence standpoint, upon IRS exam, the IRS is now going to be incentivized to identify where taxpayers may have underreported their 174 costs, which is kind of counterintuitive to how they've been traditionally auditing companies that claim an R&D credit. They're trying to say that costs, when they go and review, are trying to make sure that taxpayers aren't overstating their R&D. So now they'll have to be looking at it through a different lens. So if you do take the position that a certain cost center or group of costs don't need to be included in this amortized 174 bucket, having a good documentation package around why you made that decision, why you excluded it, could be important in the case of an audit. And there is a small implication to your R&D tax credit. So there was just a very small tweak to Section 41 of the tax code that deals with R&D credits as part of the Tax Cuts and Jobs Act. And so basically here, the key takeaway here is that essentially, because of this tax law change, any cost that you say is eligible for the R&D credit, as we mentioned before, is now mandatory to be capitalized. And we won't go into too much depth on this slide. This bullet's just a few of the international considerations that this has a ripple effect into. So from a foreign tax credit standpoint, any provision really that involves the allocation of R&E expenditures under 861, any 174 allocation through anything that relies on those 861 principles would need to be considered because it would impact that. GILTI calculation, so the requirement to capitalize and amortize foreign research and experimentation expenses over 15 years might impact the amount of tested income in a big way. Could have actually a positive impact on your 163J interest limitations, to the extent that you have increased taxable income resulting from capitalization of these costs. It might reduce the amount of disallowed business interest that you'd have in a given year. Transfer pricing is also an important thing to consider, especially if you have foreign, like CFCs, and the U.S. entity is making payments to a foreign company that's conducting research on its behalf. There could be an instance where both parties, the U.S. parent and the CFC, are having to capitalize the same activity. So just things to consider there. There's probably going to be some extra scrutiny on your transfer pricing to the extent that you don't have that in place. All right, Greg, and here's your slide. So for state and local tax implications, so as Greg mentioned, not all states will conform to these 174 changes. For example, a few that have not: Tennessee, Wisconsin, California. They're all examples of states that have not conformed to the new changes. And so taxpayers in those states where those activities occur, they can continue to deduct their R&D costs in the same manner that they did before the Tax Cuts and Jobs Act. And then taxpayers in conforming states that do adopt the Internal Revenue Code as of a certain date, to the extent that date is on or after when the Tax Cuts and Jobs Act was enacted, then, unless they have any separate provision in their state tax law that decouples them from 174, they would be expected to adopt these new changes. So Minnesota, for example, they adopt the Internal Revenue Code as of 12/31/2018, which does include the Tax Cuts and Jobs Act. So barring any legislative fixes, the new rules likely would impact your state taxes, especially since the starting point for Minnesota net income is the federal taxable income before NOLs and special deductions. But
Dave, just so everybody knows, Minnesota did conform to this provision. So if there is no federal repeal or deferral, then federal and Minnesota taxable income will be the same. If by chance we get federal legislation which repeals or defers the new law, that would require additional state conformity. So we could actually be in a situation, if we're fortunate enough that the federal rule gets put on hold, we would still have to wait for state legislation to hopefully conform to that. And as we've seen many times in the past, the Minnesota legislature does not always conform to federal law changes by the due date of tax returns.
So, Greg, do you think that might have an impact on the amount of companies that file extensions for this next year?
It definitely, we've seen these issues now for, I think, 3 or 4 years running, and this is another year where we could very, very easily be looking at not knowing what the state law is at the time that the filings are due.
Yeah, agreed. Any other points or have questions come through on the Q&A before we go to our wrap-up slide? And Greg, you're on mute.
Yeah, there is one I've got here for a software development company. You said that all software development is considered R&D. Previously, they did not count software development specifically for a client as R&D, but only product software development, which was about 30% of their work. Would you how would that impact their deduction?
Yeah, that's a great question. Yeah, and that's right. Before this Tax Cuts and Jobs Act, software development wasn't specifically mentioned in context of R&D for 174. There were some provisions with respect to, internal use software, if you're internally developing something, if it's been commercial, if you're developing it for commercial sale, lease, or license, or for third-party interaction, then there's that opportunity to claim an R&D credit on it. But outside of that, there really wasn't a whole lot of guidance specifically written into the tax law about software as it pertains to Section 174. There was a Rev Proc 2000-50 that said that software development in general, if it's internally developed, it's similar to 174, and therefore basically the Rev Proc allowed companies to fully deduct these costs as incurred, even if it wasn't eligible for the R&D credit, given some of the increased qualification hurdles that you have to meet to qualify internal use or internally developed software for the credit. But now it was specifically added to Section 174 that, and I'm using the air quotes here, any software development. And so the word any is pretty broad, and the way that I think most taxpayers are having to interpret that is, if it's only for internal use, if it's not being commercialized, or if it is being commercialized, or maybe you're developing it on behalf of a customer, if it's software development, then all of a sudden it does fall squarely within the code section of 174 and would have to be capitalized. Yeah, so I think to answer your question, software development companies are probably going to be impacted by this the most, if not as much as other development companies. All right, so next steps. And I know that was a lot of tax law to cover for a Monday during your lunch break. And this is our wrap-up slide. So if you didn't hear anything else from this presentation, these are the key takeaways. So these changes could be significant for your company. It's important to analyze your total universe of costs to understand which ones must be treated as 174. It'll be important to model the impact to your tax liability. If you haven't already, consider an R&D credit study as a means to help offset that additional tax burden, and then model the impact, to your other international and state provisions. So those are the key takeaways, but ultimately, we're here to help. Your tax advisors at Boyum have access to Aprio's team of 30 plus fully dedicated R&D specialists who live and breathe this stuff every day. And I'll geek out for a second and say that, I read legislative updates in this area at night before I go to bed. And so if you find any of this overwhelming, you're not alone. There's so many companies that are in your shoes right now, and we'd love to help you navigate and dissect what exactly this would mean for you. So if that's where you find yourself today, please don't hesitate to reach out to your advisors at Boyum. Our contact information is here. You can reach out to either of us or the folks that you normally would interact with for your tax compliance and consulting needs, and we'd be happy to continue that conversation. So Greg, that wraps up the technical content for today. So anything you'd like to add or any other questions come through?
No other questions. So I guess just if you want to go ahead and wrap it up. Yeah.
So I think unless anything else comes through, we'll give you all some time back to finish your lunch hour. And like I mentioned, if there's any way that we can help, please don't hesitate to reach out. So thank you for your time today.
Yeah, thank you, Dave.
Absolutely.
Well, thank you, everyone, for coming today. And that'll conclude our webinar.
Take care.